Now, if you go back to the same thing, so we've spoken about equity. Now let us get to something called debt or debentures. What is debt? Correct. So debt is basically when you give a certain amount of money to someone, and then you get a fixed interest rate on that money which you've given. Correct. So now debt is or bonds, as they are called, is issued by the government, whereas debentures are issued by private organizations. Correct. Private organizations is exactly where equity comes, right? You fund it. So now your question might be, hey, these organizations have already raised money through equity. Why do they have to take debt or debentures? The reason being, generally money taken through equity might not be enough, correct, to run the organization. They might need some more money, and again, so equity prices is not in your hand, correct. The prices of a stock is determined by the supply and demand, correct. So if you have higher demand, obviously the prices of your stock rises, and if you have a low demand or if you have high supply, the prices of your stock automatically drop, getting a leg, and as a result you get lesser access to high capital. So that is why equity is a much more stable form of getting money to run the organization, right. Again, so you'll have a fixed rate of interest, but this is, so generally it depends on the company. So there are multiple ratings, correct. So there are multiple ratings for bonds. So based on that, you can see you got AAA, AA, and all of that. So this rating is given by a third-party organization which studies the organization. I mean, studies the business and sees what is its what is its path to revenue, profit, and what is the likelihood that they will return your money back with interest, right. So for India, you've got Golden Pi. This is the application where you could download the app, and you can buy and participate in the debt or the bond market, right. So this has a fixed rate of interest, right. So basically it's almost like a fixed deposit in India, wherein if you put your money for a certain number of period of years, or for a certain amount of time, you will get this much money. It's very predictable. If you've ever participated if you ever had money in your fixed deposit, right, you know that at the end of this the time period, you will get this money along with your principal amount. So, and even if you want to participate, governments are the most stable in the world. So, as in, government bonds are very stable, because if the government doesn't repay its money, it probably isn't going to survive for a long time. As in, like, it might be taken over by another organization. So RBI bonds are, that is the Reserve Bank of India, also issues bonds in India, wherein you can go and participate, and even the Fed has their own bonds in the US, where you could go and purchase it. It's very stable, as I told, right. So bigger the organization, higher the rating, generally lower the interest rate offered, because for them it's easy capital to access, right. So these interest rates keep changing, and if the bond market interest goes up, generally what investors with lot of money do is remove money from the stock market, remove money from equity, and put in the bond market, because this is stable. This is predictable. Your return is highly predictable in the debt or the bond market. Now let us come to gold. This metal object, which has a lot of material and one of the oldest assets in the world. It's a store of value. So gold is basically a store of value, correct. So you know that wherever you go in the world, you are at least going to get some sort of money from it. Whereas, say, if you take a note of rupee to someone, right, who's not aware of India, who's not ever seen a rupee, he's not going to value it. Whereas gold is easy to check the quality, right. It's much more easier to check the quality of gold. We have so many sophisticated tools. It's much more easier, right. Over the years, Archimedes and all of them have evolved for us to check the quality of gold, and to ensure that the gold we are getting has the certain amount, has the right amount of is whatever you're saying it is. Whereas money, correct, or even bond papers or whatever, uh, can be forged, correct. So gold is a very good asset, but it's a very, so as a, so if you can see a theme or an underlying theme, an underlying current is, the more safer the asset is, the lesser the return is. Because so gold is one of the oldest assets we are aware of. It has been traded and sold and bought for millennia. So it's a negative hedge against stocks. So what do I mean? So imagine this, correct? So imagine this. So imagine this is the stock market, and then the price goes down. What happens is, so this is equity, correct? So let me change the ink to show gold. So when the stock market is going up, right? What people do? People remove money from gold and put in the stock market because the returns are high over there. But as soon as the stock market tanks, gold prices go up because gold is the only thing which holds value. See, stock market, as I told you, is dependent on supply and demand. So if there is no supply, there is no demand, your prices tank, the valuation of the company go down, your own ownership of the company goes down. Whereas gold, it is store of value. So it's generally, again, this is also based on supply and demand, but it's a negative hedge against gold. So as like if the stock market goes down, gold goes up in price, correct? So it is also another asset class, correct? So assets are basically something which puts money in your pocket, and over time it grows. Another interesting asset I want to talk about is called cryptocurrency, correct? So we've covered equity, we've covered debt, now we've covered gold, and now let us come to crypto, which is a very new asset. Again, crypto, people say, is a store of value, especially the blue chip cryptos, your Ethereum and Bitcoin, store of value, correct? So these blue chip cryptos are store of value because basically they, Bitcoin is not a fiat currency. What is fiat currency? Fiat currency is basically the person, right, who is printing the currency. For example, in US, it's the Fed. They can keep on printing currency, therefore having high liquidity in the market, right? They don't have anything stopping them other than the government, of course. But Bitcoin, up to 21 billion Bitcoins is only limited, correct? After that, you cannot mine more Bitcoins. So that it is fixed. There is a ceiling to it, and you cannot cross the ceiling, correct? So this makes sure that there is only a limited supply of Bitcoin, making sure that it is not pegged. So basically, when the supply increases, right, unlike currency, we cannot put more Bitcoin in the market. So that is why the price will increase, right? So it's a store of value, and it is the best performing asset in the last decade. I think around 150% every year, correct? Every year it is given 150% return. So this is amazing. So if you put 100 rupees, your money will become 350 rupees. So this is how amazing of a asset Bitcoin is. But again, highly volatile. So say even when you're buying a Bitcoin, right, the price when you go to buy it and the price when your transaction gets through or is successful is completely different. It's highly volatile, right? And so again, it's highly volatile and very, very risky, correct? Governments can ban it whenever they want, but again, the upside to it is immense. As I told, it's the best performing asset in the last decade. Now let me come to a last concept of alpha and beta. Alpha and beta basically are the first two alphabets in the Greek. It's the first two alphabets in Greek. And what is this? So alpha. So imagine this is the stock market, right? In the blue, this is what you have is the stock market, and the stock market is increasing, and this line denotes the increase in the stock market, correct? So this line denotes the increase in the stock market. So when the asset you own or whichever, so whatever, so this is not the stock market, it can be anything for that matter, any benchmark you're comparing your returns to. So when the benchmark, right, so if you underperform the benchmark by X percentage, let us call it alpha, correct, you will have a negative alpha. Whereas if you overperform or if you perform better than the actual benchmark you're comparing, you'll have a positive alpha, correct? So basically, alpha is a measure of outperformance or underperformance from a particular benchmark you are comparing to. So generally, ideally, you would like to have more, right? You'd like to outperform the benchmark. Whatever be the benchmark, you want to outperform it in order to make sure that, hey, at least I'm performing better than this is the mean, correct, of most of the people, and I'll be happy. Whereas underperformance will be negative alpha, and you need to be aware of it, and you need to find out why. Beta, on the other hand, is volatility, correct? So say suppose this is this blue line, right, is an asset, correct? This blue line is an asset, and beta is how many times. So same benchmark. So suppose this red line, right, let me take the red ink. Suppose this red line is highly, so whereas this is the benchmark, whereas your portfolio is highly volatile, correct? So beta is basically a measure of, say, suppose your asset falls by X percentage, correct? And so this is, for example, the red, extremely sorry, so the red line is the actual benchmark, and the benchmark falls by 20%, whereas your holdings only fall by 12%. So basically you have a positive beta. Your beta will be less than 1, correct? So when you have a beta less than 1, that means your assets are less volatile than the benchmark, correct? And when you have a beta greater than 1, correct, that means your assets are volatile, or the whatever your asset you're holding is much more volatile than the benchmark. Ideally you want to keep it less than 1, because see, when you want to withdraw money from your asset or want to sell off your asset and cash it, you want to make sure that it is much more stable, right? It's not very volatile, so that when you go to sell it, it shouldn't be lesser than what you paid for, or it should not vary a lot, so that you might have regret of selling it too early or at the wrong time. Finally, let us come to the alpha and beta of different equity classes. So equity has high alpha, correct? Let us compare this to a more safest instrument, debt over here, right? Equity has more alpha compared to debt, correct? But it has a lower beta, that means much more volatile than the debt market, right? You can see how stock market fluctuate every second. Debt is the benchmark for us example. So debt has definitely low alpha, that is, it's not very volatile, as in you might not get a good return, but it is highly stable. Gold on the other hand has, okay, it varies, right? It depends. So it might have higher outperformance, or it might underperform the debt market, because again, this is based on supply and demand, correct? So it might outperform or underperform the benchmark or the debt market in this situation, but it is also very stable. It's a store of value, so you can sell your gold wherever you want, whereas stocks might not be the same situation. Crypto has very high outperformance compared to the debt market, but at the same time it has very low it has very low beta value, which means it's highly volatile. You cannot bank on the crypto price. So that is why whenever you calculate, right, your alpha and your beta, make sure it's risk adjusted. So basically if you have very high beta, it's very bad, even though you generate good alpha, because then you never know, the day you want to remove your money out, it might be volatile, and when you urgently need the money, right, it might be lesser than what you paid for, correct? Whereas if you play it very safe, you might not be able to grow your wealth or grow your assets at a faster pace. So risk adjusted return is something, this is a concept, this is basically a seed I want to plant in your brain, so that you can understand what risk adjusted return is. And basically the best investment is in which you can sleep peacefully at night. So remember that, and that will bring us to the end of the video. Thank you very much, and happy investing.